Thanks everyone for having me. Hi, this is Anthony. I'm a co-founder of Coco. Basically, quick backstory on myself. I'm originally Greek, born and raised in Athens. I went to the UK to study in Cambridge and stayed thereafter in London. Been now almost 14 years. I'm an operator turned VC turned angel. So I started my career as an operator in fintech, actually, in invoice financing. That's what got me into fintech and then got me into venture. Now been 9.5 years in early stage venture, predominantly investing in what I've called fintech is everything. So the notion of fintech being a horizontal, not a vertical, that touches on all other markets. Been in different firms and different funds over time. Have led a bunch of different investments, actually around 34 to date. I think the most well known have been leading the seed round of TrueLayer in open banking, the seed of Wayflyer in revenue-based financing, the pre-seed of Primer, and many more. And back 2.5 years ago, we set out with Carmen, my co-founder, to build Cocoa out of our own experience and insight, having been VCs and then started angel investing, because we realized that the kind of relationship of trust we could build with founders was much deeper when we were an angel or we were, let's say, collaboratively investing, just from the mere fact that founders weren't pitching for a term sheet. And we love that, but we actually could use that to help founders hack the system on the VC side, because all these different venture investors we've actually grown up with are now partners at all of the top VC firms. And not only did we find ourselves in this compounding position when they were all sharing with us because we were collaborating with them, but actually we could leverage that to help founders from that position of strength. And so Cocoa is our way of putting more structure to that. We say we're an angel fund backed by tech founders. We raised the fund back in 2 years ago. It's a $17.5 million fund investing at pre-seed or round number one, if you want, across Europe. Our thesis is founders, so it's relatively generalist. Our value add is the in-house VC I explained before, plus our capital source. So 70%, 75% of our capital comes from 20 unicorn founders of Europe and other founders and operators who are an extension of our team. Still deploying from Cocoa, ramping up to the next funds, which Carmen and I will do separately. Me doubling down on what I call fintech is everything, and Carmen on generalist. But for now, still very much Cocoa and wearing the Cocoa hat on. Hopefully that paints a picture, but happy to answer other questions later as well.
Yeah, sure. Thank you so much. I think one of the questions I had for you ties in a little bit with what you just said, which is the difference between how angels think and how VCs think. And you mentioned on the website that the fundamental difference with how you work is that you think like angels, but you can kind of deploy with the VC mindset as well. So what do you think are the fundamental differences between how a VC thinks and how an angel thinks? And then how can founders use that to their advantage?
So I guess this came out of having been a lead VC for a long time and then started angel investing. And we realized that no matter how founder friendly you are as a VC, you have a structural impediment, which is that usually if you have a certain fund size, you need to have specific ownership targets, right, to make your fund economics work. And that comes at a tension on the first touch point of a relationship you have with founders, right? Because founders are pitching for a fundraise, and although many of your things will align, right? The upside potential, how you want to help them, usually the relationship of like, I want to optimize for dilution for as a founder to kind of minimize that, and the VCs want to kind of maximize their ownership, tends to come at a conflict. And that doesn't allow, let's say, a very unique relationship of trust to be built from the get-go. And so with Cocoa, though we are a fund structure per se, right, we made sure we're small enough and we put that restriction so that we don't have ownership requirements. In other words, our fund economics work no matter ownership. And so by kind of reducing that bar or removing that bar, we can act like an angel. So from the first conversation, we can be aligned with the founders, because if we're excited about what they're doing and they see the value of us, we can coexist in any round composition they want, right? Should it be like a big pre-seed, a small pre-seed? Should it be led by a multi-stage like Sequoia or a seed fund like a local Globe? We can coexist with everyone. And so that's the point of alignment we usually hook into, and we try to help them as an insider hack the system, let's say on the VC side. Hopefully that makes sense, but happy to expand on that.
Yeah. And I think one of the other things you said that you can help with, given your background, is you can answer questions that founders might have. So rather than it just be about capital, it's also about support as you kind of continue to grow and look to your next round.
Absolutely. It's so the in-house so there's two sides to it, right? One is being a network super connector. So by having an RLP base, the founders, the operators, the domain experts, and also a network of that, we try to be that super connector. A lot of VCs do that. We have a lot of our capital base be that, and we strive to do that. The other side is what we call the in-house VC, which hooks to what we just discussed, which, as you said and alluded to, is not only at the point of first fundraise, but it's in any other kind of topics in between, and also the subsequent fundraise. So if you think about it, I'm having my first founder fight. I'm not sure how to go about my board dynamics. I'm being preempted another round, and my previous VC was a multi-stage, and they're being a bit like aggressive about it. So how do I actually manage that relationship between kind of, it's a good problem to have, but like getting an index versus Sequoia. And upfront on your round, it really depends. What we found is the majority of founders are definitely not the experts on the VC side, but they might know some of that. So it's not necessarily educating on how to go about it, although that's a big part of it as well. It can be the serial founder that's chased by a lot of VCs. And that where what we do then is we try to back channel, optimize, create frameworks and close the bridge. So that application of fundraise support and VC support can be applied to different circumstances, right? The first-time founder, the green operator, the serial operator, the serial founder, and we try to adjust depending, and hopefully it can be helpful, because that's all what we've been doing, right, for the past 9.5 years or so.
Yeah, the founders in this cohort, they are what we're calling kind of post pre-seed, but they might have raised a bit of friends and family money. The average raise, as Emma mentioned, is 280K and looking for towards a seed raise. So there will be some investors on the cap table in most situations, but they'll be in a fortunate position where they can kind of plan what the cap table looks like in future. So what's your idea of what a strong cap table would look like?
Yeah, it's a good question. So I was thinking about this as an angel round versus VC round, but if you're saying the context is that most of them have done some sort of angel and yeah, friends and family round, I'll focus on the VC round. So this is my opinion, right? And there's many ways to do this, and it's more art than science, like everyone says. But I tend to go about it as optimize for a strong lead VC. Even if you end up with a co-lead situation or a co-invest, start by optimizing for a strong lead VC, right? Because that makes you ruthless also on assessing on the other side of the table, would they be a personal fit for me? Would they be value add enough? And so assume you had to pick one, who would you pick? And that puts a high bar for that. In the end of the day, ideally what I found are the best, or tends to be the best types of rounds, are the ones where there's one strong lead. What I mean strong lead is taking a good majority of a round, right? It could be 40%, 50%, 60%, 70% of a round. Why? Because you want your leads to have skin in the game. You want them when, forgive my language, shit hits the fan, to be there for you, right? You want them to be incentivized for the ups and the downs. And that's both, you have to consider their main strategy, whether they're multi-stage or seed, but generally speaking, right, like most funds want a big proportion of a round to be incentivized, to have skin in the game. And then you want to complement rounds with value-added angels or micro funds, right? Angels tend to be, sometimes they might change even your game. They might be the most value add, but it tends to be quite difficult to assess their level of availability and commitment up front. Micro funds tend to take maybe like 3-4 times the check size of an angel, but you have guaranteed 24/7 if they're a good micro fund. So it's not an either or question, right? So an ideal round for me would be you take a strong lead VC, meaning getting a good proportion of a round, and then you complement with angels and with micro funds in this market. And generally speaking, we would think of a dilution of between 15 to 25%, 20% being the midpoint, more or less. ESOP is something you should definitely think about, because you want your employees to be like the new people you're bringing and your existing employees to be incentivized. And so you want to be paying this forward. So on average, I would say that I would finish by saying like, beware of fragmentation. So, and also beware of like the diversification fallacy. So fragmentation, what I mean by that is like, having too many angels on your cap table can be a headache in itself, because just like the admin of like going and like having all of them sign and voting and liaising with them can also be a burden. So think of your cap table as expensive real estate. Every square meter counts. So there are ways of solving for that admin, but that's one. And the last bit I'd say is on basically diversification fallacy, which is a lot of times founders start from especially when they're first time founders, from a position of, well, I want like a co-lead situation or 3 VCs in this round, because that diversifies the value add. It also diversifies the risk of one of them not being excited. In the end of the day, the problem of that is that on average, a round that has a certain dilution level and is of a certain size cannot fit many VCs that would have enough skin in the game with the check size that they would be able to do, given that diversification. That's not to say that I'm against co-leads. I'm just saying there should be a bar that says, to make a case to have a co-lead, you really need to be believing on that complementary capability that the other VC is bringing, that you cannot find in other angels and micro funds, for the sacrifice of slightly less skin in the game of each of the two lead VCs. So I'll pause here, but hopefully that paints a bit of a picture of how I think about it.
That makes sense. And I think there's a few questions coming in on the chat, but we can deal with that later. Moving on to founders. So you mentioned that your thesis is backing founders. We've asked a few investors this over the course of the program, but how does a founder prove to you that they are the right founder for the business that they're running?
Look, it's difficult and it's a case by case to kind of articulate. I will say, I'll that into kind of what are some of the things that I really kind of seek out for when I look into founders. I'd say one is kind of like the why, the motivation. So like, why are they building this, right? What are they trying to achieve? Is it about money? Is it about making an impact? What's the underlying driver? I'd say an obsession. So like, whether it's a passion area, whether it's a problem they found that they've made it's their life mission to actually solve for that. Because if you take obsession and motivation together, that's usually a good proxy for grit. And grit is in some respects, a variable that's quite deterministic to early stages of success of whether you graduate to the next round. I would say a slope matters more than stock. So, basically speed of learning. So while we're assessing, usually, for example, a telling thing, because many times we meet founders when they're starting the fundraise and we're helping them, is that through the fundraise, they evolve and they learn fast and they adapt. So that level of adaptability and initial data points is quite interesting and telling on their ability to grow fast, right? And the learning curve slope. I will say that it sometimes pays off to be slightly naive, but gathering experts around you. So I found that domain expertise really matters. And of course, being from a founder market fit perspective, as we say, is important. But when you over index on that, sometimes you get basically, and I see that when it's new founders trying to find something new, right? They either can't find ideas in that space, or they don't innovate at a radical degree because they think within their own box. So being slightly naive and surrounding yourself with experts can also be a good check. So instead of answering this with like the typical shebang that most VCs had, hopefully I focused on some other elements that are quite interesting as well.
Yeah, you definitely did. That's really good to hear. So I've got like a kind of bonus question that I didn't send you before, but it came up yesterday. If someone is pitching you and they're not right for now, like you're not interested in investing now, how do they maintain that relationship with you? Is it worth maintaining that relationship with you for maybe kind of repitching a year down the line when there's more traction? How's best to manage that relationship with you, but then also with VCs and angels more widely?
Yeah, I would also answer more widely, because with Cocoa One, we tend to do like round number ones only. I mean, with a new fund, I'll be doing also seeds, so pre-seeds and seeds, whatever you want to call them, right? Round number one can be the seed if you did the angel round. I think firstly, I'll start by taking a step back and saying like the first principle that we have is like, if we take any second of the time of the founder, we try to be helpful to them at the minimum, right? And so If I take 30 minutes of the time of that founder, I'll try to be at least one introduction or a soundboard exercise or a connection to another VC that helps if I don't get there. I think that's important because it's respectful of their time, but it's also important because it means I can be valuable to founders just from a first interaction, or try to be that. Even if that's not the case, like I would encourage founders to treat all these fundraise calls not only as a reflection on like their strategy and what they're doing, but actually to use them to their advantage, right? And there's always a leverage point, right? It might be that this fund might have portfolio companies that could be potential customers, right? It could be that they have access to certain talent pools that are very interesting to you, right? So make those VCs work for it, and that's also a proxy on how interested they are, so you can get a gauge sooner on where to focus. Now extending that to what you asked, Perdy, like in the end of the day, as a VC, like, and I've been in VCs before where we would do like seeds, pre-seeds, and series A's, you know that you'll be proven wrong many times, right? And so by design, like when you pass on a founder, you know it might be that it's just not the risk return you think you can do now, or there's too many uncertainties, right? So by design, you try to be even more valuable and you try to kind of touch base. So best practice touch base with founders is this combination of like not being a distraction, but making most of that relationship. So like keeping a periodic cadence of like, I don't know, every 6 months or every quarter or every once a year, maybe quarters too high of a cadence, depending on the investor, you do a catch up with them, right? And you justify that catch up because maybe they can make introductions to customers. Maybe they can help you on the talent side. That helps you with value add, that helps you stay close to them. But more importantly, it helps you also to understand as the markets evolve, and you will have seen that now, right? 2020, 21 versus now, what different VCs expect in different rounds also evolve. And so basically getting a bit of a insight on what good looks like for Series A from investors like that, which is a moving target, will also be very helpful. Finally, it increases your likelihood of converting with those investors, because investors, as we say, like to invest in lines, not dots, right? So ideally, if they've had multiple data points of your interactions, they can see your, executions, the decisions you've been making, kind of the progress is much more likely that they'll get both emotionally attached, but they actually will convert into kind of potentially leading your next round, right? So myself, as with other investors, the ones that I'm interested in, I would have a reminder, I would catch up, I'd reach out to, and I would have coffees like, every 6 months or so, right? See where I can be helpful, where I can connect founders and, get additional data points, let's say, towards my conviction.
Yeah, I know you mentioned at the beginning that just before that, a founder will get in touch with you at the beginning of their raise, and then you can look at their speed of execution throughout the fundraise. But how do you feel about a founder like, we're not raising yet, we just want to have a coffee, like the pre-fundraising conversation to test appetite? Like, do you like that, or would you rather that someone just came to you when they're actually fundraising?
I like that. I think most venture investors like that. Sometimes I've actually, especially in 2020, 21, where everyone had FOMO that they'd miss like things, a lot of investors like up their game on like how early they'd want to meet founders, just because they want to have at least one touch point. So I think I would leverage that as a founder, because you can gain from that, gain from like understanding how it's received by some of them, and then also building a relationship. So from an investor standpoint, most VCs, I would argue, like to meet founders early. I've had actually the opposite experience, where there's a lot of like, I don't know, I don't want to name specific types of funds, but a lot of funds say they want to meet founders early, but they don't really, right? They don't really like to see how the sausage is made. They want to see like part of the, they're like, I love to meet founders early, and then that founder like morphed their proposition 3 times in the last year, because that's how the sausage is made sometimes. And then they suddenly overjudge and say, well, maybe that founder is opportunistic. They've changed, ideas so many times. It's funny, right? It's a paradox. So I would say that I'm sometimes getting the other side of things, which is founders I reach out to say like, well, we're not raising yet. We want to meet you when we're raising. And I try to push to meet them early. And because they've had that experience before from other investors, they tend to not want to take those calls. So I would say the more pre-seed and seed an investor is, the more it's a shared value exercise on having that conversation early with select few, right? You don't want to go with 20. Hopefully you can find some venture investors that know the early stages well, and that you think can be very value additive to you, maybe by proxy of industry know-how, other investments they've made, brand name they've had, and try to have those conversations early to start a relationship. And those investors will know that you won't have proven out many things and that it's very early and that this is more about building the relationship early. Other investors will try to get a lot of certainty on something that's definitely not certain, which might not be great. So I don't know if I exactly answered your question, but I'd say it's always preferred. I would caution founders to not do it too much, especially with like multi-stage or later stage founders that do sometimes seed, and actually make sure they prepare a bit and get some of the feedback from the pre-seed seed funds ahead of going out and having those conversations with some of the multi-stage if they decide to go out to talk to them as well.
Okay, cool. What would you say is the difference between when you're receiving a pitch or having the whole kind of relationship with a startup, the difference between good, great, and top 1%? And what are top 1% doing that stands out from other founders?
It's it's tough to say. So you mean as in from a pitching perspective or from a like
your relationship kind of throughout the process of having those conversations with you as you're going through DD, or just that kind of pre-check?
Yeah, or like the other way of thinking about this is like what are common mistakes being made, right, by founders? And then it's the other side of the equation. How can you optimize for it? So I'd say the first thing is how they get in front of me, right? Or, I think, and you get in front of a venture investor, doing it in a clever way matters, right? It means you put the work. It means you understood that like the likelihood of conversion to a team, to a meeting tends to be influenced by the source, right? Because we're all starved of time. And so the more it's come from a portfolio founder of mine or from another angel operator or from another VC I respect that's complementary to me, the more likelihood there is that I'll take that call, and the more I'll respect that, okay, like these founders come referred highly or at least have hacked that, which I think is something that shows hustle, it shows thoughtfulness, and it also improves the odds for founders, right? And so why am I saying this, by the way? Like the more it's from a portfolio founder of mine, the more I'll take the call no matter, right? Because I've just believed this founder with my money of like growing something. I'll definitely trust them on someone they recommend. So the more qualified the source, the better. I think the other thing is like on the form of delivery, let's say we're on a call, starting from scratch, talking about their background and organically on why they're doing what they're doing is a very important thing. Like a lot of founders tend to just want to jump into just talk through their pitch deck or talk through all these revenue models and things. Like at seed, you're still selling, the pain point, the why, the motivation, the backstory. And I think it's very important, right? Or in other words, like don't be too rigid also in your delivery. Don't be like, I want, let me just go through the deck or not. A lot of venture investors like to have conversations around the deck and will have read the deck and will be all about the value on top. Others are not that style. So being adaptable to that delivery, I think is important. Another thing is on the dynamics of around. So how you basically manage the dynamics, the momentum, bringing in the lead, even talking about pricing around. I think that's also something else to think about, right? So being focused on converting a lead VC and only talking to co-invest funds or angels if you think they can be additive towards that pursuit, increases the likelihood of a very successful round and also shows maturity on your side, right? If you're not executing a round well, that's also something that can be seen as a potential question mark, right? Like, how are they managing this? They have to make decisions about something important for them in their business, and how they're managing that is actually important. Runway and rounds, like how much you're raising and the why, I think that's really important, right? Like seeming thoughtful and determined on why and how much you're raising, but leaving a window open to kind of get feedback on that, right? So I'm raising 2 million or 2.5 million because I want to have X amount of runway, because it's important to not be guided by money only and strategically make choices. And because given the capital intensity of my model or not, this is what I think I need to get to there, which is table stakes. But like you would be surprised how many of the founders come to me and say like, oh, I'm raising 3 to 6 million, 3 to 5 million. I'm like, this is completely huge range, right? It was a very different race. So I think having that actual certainty is important. And then I would say when I hear founders talk very bottom up, I get excited. So it's like a pain point I've seen, the way I'll go to market, right? The more bottom up, the more it shows that you come from the industry, you feel the pain, you understand what you want to do. The more top down, the more theoretical, right? The more consultant like. When people talk about their go to market and distribution strategy, and they just like, for example, paraphrase different channels, and I'll go by partnerships, by affiliates, by I'm like, okay, I can also talk through the 3, 4 different points that any consultant would talk about, right? If you tell me about the first hack on the go to market or how you're seeing these communities being engaged and you've tested with that, that gets me excited. That shows that you're very much have a bias to action and understand bottom up the space you're going after. And then I'll finish by saying how you treat the conversations and the follow-ups. So and the deck itself, right? So the deck is an engagement hook, right? Or a follow-up hook. It's not the main conversation. So I keep the deck punchy, relatively small. It doesn't need to be exhaustive. You can use it as a hook to start the conversation. And these calls or these meetings should be about the value on top and the conversation on top. And you should actually act like that. I don't know if that again answers the question, but hopefully these are some best practices on what like the top 1% does when executing a fundraise versus, I don't know, some of the mistakes being made, let's say, from the good or the mediocre.
Yeah, no, that's really useful. Thank you so much. Final question from me, and then we'll go to questions from the chat, or if you want to ask a question, just raise your hand. So final thing from me, if there's one thing that you find yourself constantly saying to founders, what is it?
I'd say focus. Yeah, I would say just remaining focused, right? Focused and disciplined. And that it applies to so many things. It's focused towards the end outcome of a fundraise. It's focused when a competitor just raised a big round. It's focused when, you're starting to get distracted about all these different things because it takes longer for product market fit and you're starting to get a bit antsy about it. But, instead of being focused on understanding how you want to navigate, you hear too many noises out there and you feel that your nervousness or stress gets you into just like listening to too many people and getting unfocused. So I'd say focus. Focus is the number one thing. Focus and discipline.
Awesome. Thank you so much. I will pass to MA to handle the Q&A.
Okay.
Awesome. Thanks, Barry.
Julie, I'll call on you in just a second. But Anthony, I have a quick question to start with. What advice do you have for founders in terms of managing existing investors? Especially, we hear a lot of stories about founders who have angel investors who are giving them conflicting advice to another angel investor on the cap table, or perhaps they're sending them updates on their competitors like every week, just in terms of like focus and what we were talking about. How can founders maintain focus and good relationships with their investors?
Absolutely. So your investors are not your customers, right? They're your shareholders. I think that's a very important thing. You will always have interested shareholders if you have great customers and a great product, but not vice versa. So why am I saying this? Because a lot of times the earlier you are, the more nervous you are in trying to prove yourself, right? And the more you put a lot of weight in trying to kind of like serve the shareholders, right? Oh, this angel told me this, I need to do that. But then the other angel told me this, I need to do that. I need to show I'm doing what they're telling me. That's never the case, right? No great business was built by optimizing for that. So to turn your question into my answer, I'd say you should leverage, first of all, your investors. They're an extension of your team. They actually have to prove themselves. So they came in as part of shareholders in your journey to add value to you. So first of all, make use of them. Don't feel like they're the people you report to and that you're nervous about. It's the people you need to put to work and that they need to be proving value to you. That's the one thing. The second is, as with everything, you have shareholders. They will all give you advice, right? Critical thinking, use all of it, and digest all of it, and then see what you want to act on, right? There's no one better placed positioned to be executing on what you're doing than yourself, or at least that's what you believe in. That's why you set out in the journey. And also you're 24/7 thinking about these things, right? So all these are data inputs. Not necessarily acting on an advice of an angel investor doesn't mean you're neglecting them. It might actually mean that you considered all of that and weighting it with other things, you made a different decision. And a good angel investor should understand that and respect that.
All right, thanks. Jolie, I just saw your comment in the chat, but you said you have another question too, so go for it.
Yeah, I have so many. Thank you so much, Anthony. I hope you can hear me okay.
Yes, it's perfect.
Great, cool.
Hey, Julie.
And yeah, great advice. My company is called Horizon. What we do is we use data science and AI to optimize mental physical health for athletes. But I'm not here to sell the business, so I'm going to go into the question straight away. I think thinking more from the B2B side, because that's the business model we are going for, B2B2C. And from an investor perspective, we keep saying, we keep hearing that, you know, in the current market, in the current climate, you need to prove you have traction, you have revenue. But in this space, even we have kind of negotiations going on, it is having quite a long lead time. So I just wonder, from the business model and traction perspective, what do you see as good proof points? For example, with the free pilots that we have run with potential customers, you see as value, or you say that's free, that doesn't count. What do you think about pipeline incomes? And also, I guess in the way is our business model can change as well. Even if it's B2B2C, there's different variations in that one. How much do you want us to prove, because it's constantly changing dynamic? I just wonder from investors' perspective, what's your view on this?
No, it's a great question. Hopefully I can have a good answer. I will say that with market tendencies, people over-index on, the pendulum swings, right? So if it's a bull market, everything's about momentum and growth with nothing else, and who cares, right? It's the future and the sell. The more we're in a bear market, or at least for tech, the more people are focused on fundamentals, and that translates into revenues. I will also say, though, that the best investors do understand that venture is all about, at least early stage venture is about catching companies at their inflection point. So a good Series A investor won't over-index on whether you have 1, 2, 3 million. They will over-index on understanding your input variables that show an inflection point about to create some sort of like good explosion of a rocket ship. And I was talking about that with Sequoia, actually, a friend of mine there. And so, you can see Series A companies that raise at like 400K or 600K ARR, but actually the reason why they raise and it's had such a hyped round, it's maybe it happened in 2 months and it's growing super fast. And if you look at the underlying data, it shows like customer love and some sort of viral effect. That is a superior picture than a 2-3 million ARR company that took them 4 years to get there, where they have a leaky bucket and churn within their customers and the likes. Now, to go more targeted to your question, I would say within B2B2C, I think what matters most, or in the early days, a lead indicator is conversion. So like the uptake of end employees, if it's an employee product or whatever that is. So if you're selling via that channel B2B, B2B2C, the kind of conversion towards 2C is what matters most, right? Of course, signing a few customers is already a great proof point that there's market validation that you're selling something that people want. But actually, if you want to prove or starting to show proof points that you're building a product that people can love or might love, it's about the end conversion and then looking at the end engagement or whatever that data is on the end consumer. So these are the input variables towards like revenues and output variable, if that makes sense.
Yeah, can I just very quickly follow up? That's super useful. Just thinking about if we have end customers, I mean, they are direct consumers. If they are willing to pay it, is that a good proof point as well? I mean, we are not going into B2C, but we can demonstrate there's, end users who are willing to pay it, even not through an organization.
Yeah, of course. I mean, of course, willingness to pay is a different proof point, right? I think ideally, and now we're talking more of a Series A than a seed, right? Situation. You want to prove that you have a channel that works, an end conversion that works, and a consumer that's willing to pay and is engaged. Willingness to pay is a proxy for people seeing value into it, right? Now, if for some reason organizations are not willing to pay, when it's B2B2C, it's a lot about like can you monetize it properly? Can you land and expand? Do you have a good end conversion? And is this an end consumer product, right? Or is this just another distribution channel? And so if it is an end consumer product and you can close the loop, what is exciting about B2B2C businesses usually is that this B2B serves for good monetization, the 2C serves for good conversion, good fast distribution. And if you own the end consumer with the product you've sold, you can cross-sell, upsell a lot of things over time, right? That's the exciting side. So towards that story of excitement, all these data points help, right? Closing the first customers, proving the conversion, showing that the end consumer is willing to pay even from a different channel, right? And at the seed stage, you can have a fragmented story with some proof points towards it, right? You're not selling a fully baked product market fit story. So absolutely.
Thank
All
you.
right. I'm going to take a question from Mark in the chat. You've touched on this a little bit, but it's from your experience so far, what patterns have you observed in the startups that have successfully gone from pre-seed to a thriving business / IPO? Why did they succeed when others failed?
I would say the capacity to be creative when things are not working or are starting to work. So I will say first the kind of like journey towards product market fit in Series A. So because it's different muscles you want to see in each time, there's certain characteristics that I think are universal at the founder level. But I would say from kind of pre-seed angel to kind of Series A, it's a lot about the capacity to be creative, right? If it works, you might end up figuring out from the customer that the opportunity is much wider. So you want to morph the proposition quite fast to make sure you're capturing that. Or if it doesn't work and your hypothesis was wrong, how do you pivot or shape that company to go towards product market fit? I think that's the 0 to 1, right? The 1 to 10 is about starting to get a very good lever of your business while starting to scale yourself slowly but surely. So suddenly what you've learned being the success, which is you having a full pulse and control of the business, it's the opposite. So you need to start giving the reins back to other people. So successful hiring and putting this as a priority and realizing like suddenly that actually leverage on your time is the success now, while you're starting to get a really good grasp of your business metrics so that it can become quite a machine, right? And so if you manage to do that by like 10 million ARR or whatever that is, the 1 to 10, you're starting to have a business that's about to get a VP layer of people, which would make you kind of focusing more and more on strategy and culture and direction, but you're not there yet. But absolutely, you've made great hires. You've scaled yourself also in the capacity of what makes a successful CEO. And you now have full levers on the analytics that make your company like work. So ideally, you have a CFO that's more like a chief analytics officer. And you know, if you put X amount in, X amount goes out. That's when you're about to scale. And that's when you raise usually a good Series B. Then from Series B to IPO, it's a lot about like the tough parts, right? Like direction, scaling, keep pushing, maintaining culture, being a leader, and all of that. Now, the pre-IPO and IPO story is a completely different muscle again in and on itself. And it's about being like, I guess, much more predictable on your business and your fundamentals and, you know, having quite a profitable story and knowing and having a full handle into that while you're playing towards, you know, hopefully still quite a huge opportunity. So within all that and that journey, if you think about what I've been talking about, there's grit, there's plasticity, right, of yourself and then, yeah, I guess focus, dedication. I mean, unfortunately, there's no like one like cocktail that brings success. Otherwise, everyone would be kind of drinking a pina colada somewhere, right? So, but I think that's, I would say, if I would have to outline, that's a high level.
That is a wonderful overview. Thank you. Okay, Noel, you are up.
Hi, Anthony. Can you guys hear me?
Yes, hey, Noel.
Yeah. Hi, Anthony. Great. Really enjoyed listening to your insights. I have two specific questions. One is you referred to lead VC. At a pre-seed or even a seed level, or let's say pre-seed level, is it better to have a lead VC to lead the round, or maybe look at the opportunity to get a syndicate of angels and to do that? Because I see that relationship dynamic might be a lot different as you go down the investor management side, especially when you might have, you know, different opinions and how do you have to make decisions. So that's my first question. The second question I'll get to very quickly is that you mentioned about founders having to be very slick in executing the fundraise. A long time ago in a previous life, I worked in KPMG corporate finance, and my job was to raise funding for large corporates, and CEOs and CFOs used to hire me to execute a very sleek fundraising that was running into hundreds of millions. But a founder in a startup is in a complete different pace. They may not have the best pitch deck. They may not be the sleekest speaker. But as an investor and angel, having, you know, when you're so busy having to read so many pitch decks and meet so many investors, how do you mitigate that you might potentially lose an investment opportunity because of certain pitfalls a founder might have that, say, large corporates may not have because they've hired a big fundraiser to go and do the job for them? So how do you do that? So I have two questions there for you, and look forward to hearing from that.
For sure. Thank you for those. And let me know if I don't address them. Hopefully I do. And the first question was referring to a pre-seed, right? Not like a seed, kind of a pre-seed. Okay, perfect. So that was the other part I was going to say. Like when you do a pre-seed round, I think you want to make a decision that's very conscious, which is, do you want to rate a VC-led round or do you want to do an angel round, right? Even if it's a pre-seed. I think VC rounds have a lot of benefits, but also have some precautions, right? Usually, you know, VCs can scale their money. Usually they can institutionalize you a bit, and the mindset they can support in some of the with their network, right, quite heavily, and on the mindset, and surround you with great people. And hopefully if they're value-add investors, they have a lot of things on their platform to offer, right, from hiring to kind of connectivity to, you know, hands-on support depending on the venture, right? Now, with a VC round, you jump on a bandwagon of a VC journey by design, right? So I think you lose potentially optionality in the future of what you want to do. And so, you know, the moment you get VC money, it's about runway and milestones and keep pushing and growing fast. And if you don't, it's like rocket fuel, right? You like, you know, reach the moon or otherwise combust in some respects. You might end up among the stars, as people say, right? But like in the end of the day, I would say when you go through the VC round, you are more or less putting yourself in a specific route. Of course, the more it's seed funds, the more they understand that there's many scenario in the future, and it's not only about like pushing you towards that or combusting, but it's still the case that seed funds will invest in you being potentially a 60x multiple in a success case, right? Like that's a fund returner for them in some respects. So you need to understand what drives them. So this is the defaults, right? The angel round, assuming you can do quite a speedy and good angel round. Oh, the last thing I'd say with VC is like the pricing tends to be relatively good. I mean, the markets will tell what the pricing is in the end, but at least, you know, the terms, the structure, the docs, the whole process, if you go through, and that's all assuming you're going through like a good tier one VC, you'll basically get good standardized docs, which are very important also for your next round, right? Because every round, they use basically the previous docs, your shareholder agreement, your articles, your as a baseline for the negotiation of the next round, right? The angel round, assuming you can do it fast, it's a case of saying, okay, well, I have a network of other operators and founders from the domain or from the place I'm going through, so I can gather around me a lot of like interesting value-added people quite fast without institutionalizing this. So it's probably going to be a more speedy process. There's going to be less structure and standardization to it. Plus, it gives you a chance to say, you know what, maybe this is a company I might want to do like a bootstrap after, or let's say I get to profitability and then build a successful business, right? I think in 2021, everyone prescribed VC as the, you know, painkiller for everything, but it's actually not. So there's many businesses that can be the top in their category that don't need venture money, or many founders that don't necessarily need to go to this obsession of like building a $10 billion company or towards that, right? With that kind of power, right? The moment you get VC, you're increasing the risk of the business by default because you're accelerating. So an angel round can serve to that. Angel rounds are usually smaller. You don't want to structure them to be as large because you don't want them to be translated as this is how much you raised for that runway and for that round. So ideal angel rounds are smaller. They get you towards some sort of element of either profitability or towards giving data points to yourself on whether this is a business you want to really take to a venture journey, and can happen much faster. Now, it's not money that scales. The term is like, who sets the price, and how do you know that this is not going to kill your next round if you do want to go into a VC round? And beware of structuring this as an angel round that ends up being perceived as a proper round, because then you might end up raising less but still being expected to achieve the same. So to answer your round, I think both are feasible, both have goods and bads, and you should make a conscious decision. One gives you more optionality, but less kind of like market standard and less kind of capital that scales. The other gives you more of that, but comes with a caution of like, you're starting to go towards that journey of like really accelerating. So that's what I would say on your first question. Hopefully that answers that. Second question, remind me.
Second question, what I was referring to was how, as an investor, how do you mitigate the risk of losing out on an opportunity? Because as you say, as I said, in startups, a founder may not really be the best, be as slick in executing. Yeah, exactly.
So maybe I overstated it before, so it's good that you're touching on that. So I as an investor, I don't assess on whether you're the most slickest fundraiser, right? Actually, it could be a yellow flag if you're like too good. It's like, is this person bullshitting me? Like, is it, it's like, I don't know. It's too shiny. What I am saying is you can observe the way in which they execute that fundraise and the way in which they learn fast. So if you're doing it for the first time, you're still having to make decisions, right? Sequencing, following up, how fast you push, who do you prioritize, and all that in the caveat of the fact that you're doing it for the first time, but also within 1 or 2 weeks, the way in which you treat things, how you're doing things that are coming repeatedly and how you're doing them better, you can actually observe the slope. So how good you're getting towards it, right? So I would never necessarily assess on someone's ability to be a great fundraiser. I would assess the choices they make while they're fundraising, and you can start deciphering some of the speed of learning. That's what I was saying. Now you can also say that nowadays you have a lot of content out there and a lot of open source like knowledge on how to go about some of the table stakes, or even like talks like these, right? The great stuff that the guys are organizing. So if you have the grit and determination to build something great and you want to go into the venture space, if you're curious enough, you'll probably stumble across some of that advice. You'll get baseline information. Now it's becoming table stakes, which is great, because otherwise you have you have a problem right at the top of the funnel of like whether you're just getting privileged founders through that. Now, if that's the case, then it's about what I just said, right? Like speed of learning and choices being made. I don't know if that makes sense, but it's much less about, did you price it well? Did you connect to the best people? Yeah. And definitely don't hire like a placement agent or an advisor at the pre-seed seat, which I know is not what you advocated for, but tends to be a yellow flag or even a red flag, right? Because it's a bit like you're now hustling in the early days. You really need help for that. I mean,